Hey, welcome back everyone. So today we're going to go ahead and look at Microsoft stock. We'll take a look at the financials, growth of the company, and let's see what it's worth. However, before that, don't forget to give the video a thumbs up and sub to the channel if you are not already. And with that, let's get right into it. Okay, so looking at Microsoft's growth over the last 5 years, we go from 2017 to 2021. And we've got 96.5 billion in revenue, all the way up to 168 billion in revenue for 2021. Now, that is very good growth, but sometimes when you're looking at, big numbers like this, it throws people off a little, and they're thinking, oh my God, like they must have grown like 20% a year or something like that. And if we run a compound annual growth rate on them, they actually grew 11.7%. Although for the size of the company, that is really good growth. Now let's get back into it, and we're looking at net income growth. 2017 to 2021, you got 25.4 billion up to 61.2 billion. Yep, check. That's good growth. Then free cash flow, you have from 2017 to 2021. 31.3 billion up to 56.1 billion. So, I mean, look, when you're investing or you want to invest in a, stable company that's a bigger company, you definitely want to see that you're checking all the boxes in these areas. You want to see that revenue is still growing. You want to see that net income and free cash flow are still growing, and they are still growing very healthily with Microsoft. So, looking good. Next thing I always like to look at is the debt of a company. We want to make sure that they can afford their debt. So let's go ahead. Okay, so we want to go ahead and look at the average last 5 years of free cash flow. Then I like to multiply it by 3, which is 121.9 billion in this case. And I like to see that our long-term liabilities for the company are under this amount. They indeed are at 102 billion. Next, I like to see that the current assets outweigh the current liabilities. So all you really want to see with this is that if the company were to liquidate today, could the current assets cover the current liabilities? And in this case, they certainly can. 184 billion current assets divided by current liabilities of about 88.6 billion. Now remember, any number over 1 means that they can cover all the current liabilities, but I like to see the number closer to 2, and yeah, this is definitely right around 2. That's a perfect number to be at. Okay, last but not least, we want to look at the DCF model. We want to look at what this company could be worth today based on the model, and to start that off, we need to find a revenue growth rate that we're comfortable with. So there's quite a few things to consider when it comes to this. Remember, our compound annual growth rate was 11.7% for the average growth rate over the last 5 years. However, there's another part to the story when it comes to that if we're looking for a fair revenue growth rate. First of all, even though 11.7% was that CAGR, we do have to take into account that the last couple years of growth have really been where they've sparked, so you sometimes have to take that into consideration. For example, 2021's growth was about 17.5%. Also, your average analysts are expecting 2022's growth to be about 18.5%. And the following year, they expect about 14% growth. Also, if you look at Yahoo estimates, they're anticipating about 17.5% growth as an average over the next 5 years. Now, all of those things considered, I went ahead and gave Microsoft 15% growth rate for revenue over the next 5 years. The analysts all seem to be pointing to the fact that they're probably going to stay closer to above 15% growth over the next 5 years. But we have to, even though this is considered a premium company and a very stable, good growing company, we still need to remain a little conservative. So let's go with the 15%. Okay, so we come to our DCF model here. We grow that revenue out by 15% out to the year 2026 and get 338 billion in revenue. We also have to apply a free cash flow margin. So keep in mind, free cash flow margin is just free cash flow divided by the revenue. You want to get a margin based on what that free cash flow is versus your revenue. So I did look at the last 5 years, and you had quite a few numbers that were definitely above 30%. Actually, 4 out of 5 of them were. You had 32.5%. 29.2%, 30.4%, 31.6%, and 33.3% in the year 2021. All things considered, you can see just how consistent they are with free cash flow margin. I think 30% is a very good number to use. So we apply that 30% free cash flow margin to all the projected revenues, and we get all the numbers here showing as your projected free cash flows out into the future. We need to get a terminal value. You base that off of a weighted average cost of capital, mine 6.8% that I get from finbox.com, and you have to apply a perpetual growth rate. I apply 2.5%. Now we have to apply our discount rate of 12%, all the numbers here showing. And you get all the values down here after applying that discount rate. We add all of those values up. And here you see all the added values. You must then divide by shares outstanding. And we get an intrinsic value of 219.45, or roughly fair value of 219 a share. Okay, so here we are again. When I did my Amazon video, if you have not seen that, the fair value was way lower than where the current share price is. People seem to be really willing to pay a huge premium for companies right now that are very premium and stable, I suppose. But, I mean, look, brass tacks, no matter which way you look at it, I think Microsoft is around like 280 a share right now, even after all the drops that we've had in the market. And fair value, according to the DCF model, is 219 a share. And I feel personally I could have been a lot more conservative with this model, but I chose not to be. I gave it a little bit of a premium because it's a premium company. After all that, based on the numbers, based on projected free cash flow, and discounting them back, that's what the DCF model is, the discount cash flow model, we come out with a fair value of 219 a share. According to the model, definitely not a buy, not a stock that I'm buying. It always seems when I do a valuation and a stock analysis on some of these bigger companies, people get mad saying I'm not valuing it correctly, but the DCF model is the absolute best and most accurate way to value a company. And yes, it can be very sensitive to the information you put in, but I feel I was very fair about the revenue growth rate and the free cash flow margin. So look, I'm willing to pay based on what we project out for future free cash flows and discount back. In my opinion, and based on the model and the numbers we used, you're overpaying for Microsoft right now if you're buying them at current share price. Okay, so that's going to bring us to the end of our video here. Let me know down below what you think about Microsoft. Do you own Microsoft? Are you looking to own Microsoft? Do you feel there's something I'm missing? Please, definitely let me know down below if you feel that I'm missing something when it comes to a company like Microsoft, where according to the model and personally, I feel that the current share price is very overinflated. But let me know your thoughts down below. And that's all I've got for you guys. So you have a good one, and I'll see you in the next one.